Buying a house versus investing. The real math: Jake buys a house. Marcus invests in the stock market. They both start with the same amount of money, the same income, the same age, the same opportunity. 30 years later, one of them will end up dramatically wealthier than the other. But here's the strange part. If you asked most people today which decision creates more wealth, most would confidently give you an answer. And many of them would be wrong. Because when people compare buying a house to investing, they rarely compare the actual numbers. They compare emotions. A house feels like success. An investment account feels like a spreadsheet. A house gives you something you can touch. An investment account gives you numbers on a screen. And that's exactly why this comparison is so fascinating. Today we're going to run the full math, not the social media version, not the real estate guru version, not the stock market influencer version, the actual math. We're going to see what happens when two people make one different financial decision and stick with it for the next 30 years. But before we start, I want you to do something. Pick a side right now. If someone handed you $50,000 today, would you buy a house or would you invest it? Comment your answer below before we reveal the numbers, because over the next 30 years, it does not disappear. One of these decisions could quietly put hundreds of thousands of extra dollars into your pocket. And most people don't realize whether they made the right choice until it's far too late to change it. So lock in your answer now. Let's see who wins. Meet Jake. Jake is 25 years old. He's spent years saving money, skipping vacations, driving an older car, saying no to things his friends said yes to. And finally, after years of discipline, he's managed to save $50,000. To Jake, this money represents freedom, a fresh start, chance to build something. After months of looking, he finds a house worth $250,000 in a decent neighborhood. Nothing fancy, nothing luxurious. Just a solid home in a good area. He uses his entire $50,000 as a down payment. The rest is financed through a 30-year mortgage. The day he gets the keys feels incredible. His parents are proud of him. His friends congratulate him. People tell him he's making smart moves. For the first time in his life, Jake feels like he's getting ahead. And honestly, most people would probably agree. Now let's meet Marcus. Marcus is also 25 years old. He has the exact same $50,000, the exact same salary, the exact same goals. But instead of buying a house, Marcus does something that sounds incredibly boring. He invests the entire $50,000 into a low-cost S&P 500 index fund. Then he sets up an automatic investment of $500 every single month. That's it. No mortgage, no property, no moving trucks, no keys. No congratulations. When people ask Marcus what he's doing with his money, his answer usually ends the conversation. I invest in index funds. Nobody is impressed. Nobody tells him he's a genius. It does not disappear. Nobody asks him for advice. In fact, some people think he's making a mistake. And that's what makes this story so interesting. Because during the first few years, Jake looks like the clear winner. He owns a house. Marcus owns a brokerage account. Jake has something he can walk through. Marcus has something he can log into. Jake gets social proof. Marcus gets silence. If we stopped the story right here, almost everyone would choose Jake. But wealth isn't built in the first year. It's built over decades. And over the next few years, both Jake and Marcus are about to discover something that nobody warned them about. The first 5 years, for the first few months, everything feels like it's working perfectly for Jake. Every mortgage payment feels productive. Unlike rent, the money isn't disappearing. At least that's what he tells himself. He spends weekends painting rooms, replacing light fixtures, working in the yard. Every improvement makes the house feel more valuable. More importantly, it feels like he's building wealth. And honestly, there is some truth to that. Each month, a small portion of his mortgage payment goes toward principal, slowly increasing his ownership stake in the property. At the same time, home prices in his area begin rising. Nothing crazy. Just a normal 3% to 4% annual appreciation. The kind of growth homeowners love to talk about. And from the outside looking in, Jake appears to be winning. Meanwhile, Marcus's life looks incredibly boring. It does not disappear. His investment account doesn't send him congratulations. It doesn't give him a set of keys. It doesn't make him feel successful. Most months, he doesn't even check it. The original $50,000 is invested. The automatic $500 monthly contributions continue month after month, without excitement, without drama, without attention. And that's exactly why most people underestimate what happens next. Because while Jake is feeling wealthier, Marcus is quietly becoming wealthier. But before we get to that, reality starts knocking on Jake's door, literally. About a year after moving in, the water heater fails. The repair costs over $5,500. Not catastrophic, but definitely unexpected. A few months later, property taxes increase. Insurance premiums go up too. Then the air conditioning system starts acting up. Another bill, another expense. Nothing devastating. Just constant reminders that owning a house costs more than the mortgage payment. And this is where many first-time buyers make a mistake. They compare rent to the mortgage, instead of comparing rent to the total cost of ownership. Because the mortgage is only the beginning. There are taxes, insurance, maintenance, repairs, unexpected expenses. And eventually, major replacements. The roof, the HVAC system, the plumbing. Things renters never have to think about. Jake isn't losing money, but he's definitely spending more than he expected. At the same time, Marcus is experiencing something completely different. Absolutely nothing. And that's the strange part. The best investments often feel boring. Year after year, Marcus keeps investing. The market goes up, then it goes down, then it goes up again. Some months his account loses money. Some months it gains money. But he keeps buying every single month, whether the headlines are optimistic or terrifying. And that's where compounding starts working behind the scenes. At first, it's invisible. Almost disappointingly invisible. The first few years don't look impressive, but that's how compounding always works. It whispers before it roars. By year 3, Jake's house is worth roughly $275,000. On paper, that feels great. His home value has increased. He's built some equity. His net worth is growing, at least partially. Marcus, meanwhile, has invested his original $50,000 plus another $18,000 through monthly contributions. Depending on market returns, his portfolio is now approaching 6 figures. Not because he did anything special. Not because he found the perfect stock. Not because he timed the market. Simply because he stayed invested. And for the first time, the gap between effort and reward becomes noticeable. Jake is constantly involved in his investment. Marcus is barely thinking about his. Yet their wealth is starting to look surprisingly similar. And that's where this comparison becomes really interesting. Because up until now, most people would still choose Jake's path. The house feels safer. It feels more real. It feels more successful. But over the next 5 years, something happens that changes the entire story. The force that quietly builds most fortunes finally starts accelerating. And once it does, the numbers begin moving much faster than most people expect.
Years 5 to 10. When the numbers start telling a different story by year 5, Jake feels pretty good about his decision. The house has continued to appreciate. His neighborhood is improving. A new shopping center opened nearby. Property values are climbing. On paper, his house is now worth somewhere around $290,000 to $310,000. And every time he checks online estimates, he feels a little richer. His mortgage balance is also slowly shrinking, not quickly, but steadily. For the first time, Jake starts talking about real estate differently. He no longer says he's buying a house. He says he's building equity. And honestly, he's right. That's exactly what he's doing. But something else is happening at the same time. The expenses haven't stopped. Over the last few years, he's paid thousands in property taxes, thousands more in insurance, a few repairs here, a few repairs there. Nothing dramatic, just the normal reality of owning a home. The kind of costs nobody includes when they brag about how much their house increased in value. Meanwhile, Marcus is entering a completely different phase. For years, his portfolio felt boring. Now it starts feeling interesting, because the gains are no longer coming mostly from his contributions. They're coming from the money already invested. And that's a huge shift. Most people think wealth is built by working harder, but eventually wealth starts building itself. That's what compounding does. At first, you build the snowball. Then the snowball starts building itself. By year 7, Marcus logs into his account and notices something strange. Some years, his investments made more money than he personally contributed. Think about that for a second. He's still investing $500 every month, but the market is now generating thousands of dollars without any additional effort from him. No tenants, no maintenance, no mortgage paperwork, no repair bills. Just time. And time is becoming incredibly valuable. This is where the emotional battle begins, because Jake still feels like he's winning. His investment is visible. He can drive past it, touch it, live in it, show it to friends. Marcus can't do any of that. All he sees are numbers. And humans naturally trust what they can see. But wealth doesn't care about feelings. Wealth only cares about math. By year 10, the comparison becomes much more interesting. Jake's house is now worth approximately $335,000 to $350,000. His mortgage balance has fallen significantly. His total equity sits somewhere between $170,000 and $190,000, depending on local market conditions. That's real wealth. Nobody can take that away from him. And if you stop the comparison right here, many people would still declare Jake the winner. But then we look at Marcus. Marcus has now invested for an entire decade. His original $50,000 is still there. His monthly contributions have continued. And compounding has been quietly working every single day. His portfolio has now grown to roughly $180,000 to $220,000, depending on market performance, without leverage, without debt, without maintenance, without a single emergency expense. For the first time in the entire story, Marcus is no longer the boring guy with a spreadsheet. He's becoming serious competition. And here's the part most people never think about. Jake's wealth is tied to one asset, one location, one housing market, one property. Marcus owns tiny pieces of hundreds of the largest companies in America. Different industries, different sectors, different sources of profit. Their money is growing in completely different ways. And that difference becomes incredibly important during the next decade, because the years between 10 and 20 are where most fortunes are actually made. Not because people suddenly start earning more money, but because compounding starts doing something that feels almost unfair. And when we compare Jake and Marcus again at year 20, one of them is about to experience a level of growth that shocks almost everyone the first time they see it. Before we get there, I want to ask you something. Have the results surprised you so far? Because most people make financial decisions based on emotions. Very few people take the time to follow the numbers all the way to the end. If you're enjoying these real-world money simulations and want more videos that break down major financial decisions using actual math instead of opinions, subscribe to Philly Finance. Every week, we run the numbers on the choices that shape your financial future. Now let's see what happens during the decade that changes everything.
Part 4, years 10 to 20. The decade that changes everything. If the first 10 years were about patience, the next 10 years are about momentum. And this is where most people completely misunderstand how wealth is actually built. Because by year 10, Jake and Marcus are surprisingly close. Jake has a valuable home. Marcus has a growing portfolio. Neither one has completely pulled away. But from this point forward, the game changes. And it changes because of one simple fact. Compounding doesn't grow in a straight line. It grows like a snowball rolling downhill. Small at first, then faster, then almost impossible to stop. By year 12, Jake is still doing what homeowners do, paying the mortgage, maintaining the property, handling repairs, replacing things that wear out. This time, it's a new HVAC system. The bill is over $8,000. Not because Jake made a mistake. Not because he bought a bad house. Because houses age. Everything eventually needs to be repaired or replaced. The roof, the plumbing, the electrical system. The appliances. These aren't surprises. They're guarantees. The only surprise is when they happen. Meanwhile, Marcus has experienced something completely different. His portfolio has gone through market corrections. A few scary headlines. A few red months. A few moments where it felt like everything was falling apart. But he never stopped investing. Every month, the same $500. Again and again and again. Most investors never become wealthy because they quit too early. Marcus didn't. And now the rewards are starting to show. By year 15, something remarkable happens. Marcus's investments are generating more wealth each year than many people save in an entire year. Think about that. For years, his contributions were doing most of the work. Now, the portfolio itself is doing most of the work. The machine is running. And every additional year makes it stronger. This is the point where compounding starts feeling unfair. Not because it is, but because most people never stay invested long enough to experience it. At the same time, Jake's situation is becoming more complicated. His house has appreciated nicely. The value continues rising. His mortgage balance continues falling. His equity is growing. But the growth comes with responsibility. And responsibility comes with cost. Every dollar of appreciation looks great on paper, until you remember the taxes, the insurance, the maintenance, the repairs, and all the money spent keeping the property valuable. Again, Jake is not losing. Far from it. He's building wealth, but he's working for that wealth every single year. Marcus isn't. And that difference becomes impossible to ignore. By year 20, Jake's house is worth somewhere between $450,000 and $500,000, depending on the market. His mortgage balance is dramatically lower. His equity is substantial. On paper, he looks successful. And honestly, he is successful. Most people would be thrilled to be in his position. But now, let's look at Marcus. After 20 years of consistent investing, 20 years of patience, 20 years of ignoring noise, his portfolio has reached somewhere between $550,000 and $650,000, depending on market performance. And here's what makes this so shocking. Marcus didn't work harder. He didn't earn more money. He didn't discover a secret investment. He simply gave compounding enough time to work. That's it. No magic, no shortcuts, no financial hacks, just time. And for the first time in this entire comparison, Marcus has pulled ahead. Not by a little, by enough that people start asking different questions. Suddenly, nobody cares that he doesn't own a house. Nobody cares that investing looked boring in year 3. Because wealth has a strange way of making boring decisions look brilliant in hindsight. But before we declare a winner, there's one final decade left. And that final decade changes everything. Because the gap between year 20 and year 30 is larger than most people can imagine. The money starts moving differently. The growth starts accelerating differently. And the person who wins this comparison may not be who you think. Let's see what happens during the final 10 years.